This is Market Wrap with Mo Ansari.
Welcome back, everyone, to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for the last 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. But for the next few minutes, hold your calls, because today we start our year in review, year in preview broadcast, and we are going to be joined by some of the top brains with I believe, some of the top ideas that we can get in each particular sector. We are going to be joined today by Dr. Alan Sinai, President, Chief Executive Officer, and Chief Global Economist and Strategist at Decision Economics. Dr. Sinai is responsible for Decision Economics forecast analysis of the U.S. and world economic and financial markets, and translating this information for use in bottom-line decisions by senior-level decision-makers in financial institutions, corporations, and governments. Dr. Sinai is one of the most respected economists, I believe, today, and gives us some very, very good insights. So let's go directly to our guest line. Dr. Sinai, welcome to Market Wrap.
Well, thank you. Thank you for that lovely introduction. I appreciate it.
Well, thank you for being with us. I know you're extremely busy, especially at this time of the year. I appreciate you taking the time out. Let's start by looking at the U.S. economy, where we are now and where we are headed. The biggest thing that we are looking at is government spending. We are in the midst of economic recovery. Last quarter, GDP close to 3%. This quarter, we could get close to 4%. A number of the economists are revising their numbers upward. But again, end demand is the key, and that is going to be a significant part of this recovery moving forward. Is it all due to inventory rebuilding and government stimulus, and how sustainable is this recovery that we're in right now?
Well, once recoveries get going, they are sustainable. They various categories of spending are mutually reinforcing, and we are in a sustainable recovery. It will turn to expansion. It's good for 3 or 4 years at least. The question is how strong and what kind of recovery. And there, so far, compared to others that we have had after deep downturns, it's very, very modest. We are getting now an improvement in inventories. We're getting good-sized government spending, better consumer spending the first 2 months of the fourth quarter. So I think we're going to do 3.5% to 4%. But beyond that, okay, but not great would be the way I would describe the recovery in terms of final demands, particularly private sector final demands.
That's the U.S. consumer.
Federal and state and local government, with government support, that really is providing a lot of upward impetus this time to the overall summary measure of our economy, which is real GDP.
Dr. Sinai, when we look at this, the U.S. consumer is pulling back in a way not seen since the Second World War, and businesses are following suit. As you just mentioned, the government is doing the heavy lifting. Is this sustainable if we continue to see the consumer saying, you know what, demographics are saying we are getting older, we're getting to that 50-year sort of retirement age, let's spend a little bit less. Can the government continue and step into what the U.S. consumer and businesses pull back? Can the U.S. government pick all of that up?
Well, first of all, even with weak consumer spending, it'll be positive, and it is 70% of the economy. So even if consumer spending grows at half or two-thirds the rate that it typically has over decades, the U.S. overall economy will grow. It just will be anemic growth of 2 to 3%. The government is going to, at the end of 2010, the stimulus program that we passed in February of 2009 will end.
Right.
And on the fiscal side, the government is doing a little more. I think they're going to end up doing more to sustain the recovery. If we keep on doing it through spending, the government will have to keep on doing more to keep our growth rate, or to try to get our growth rate high enough to reduce unemployment. I think they're going to do that. The Federal Reserve, which has done a lot of heavy lifting, your words, a lot of heavy lifting in terms of providing credit to the private sector and shoring up the banking system, preventing it from collapsing, and keeping interest rates extremely low. I think over the next year or so, the Federal Reserve is going to withdraw that stimulus, and we are going to have a question. I think recovery isn't the question. The question is how fast that recovery, and will it make a dent in the unemployment that we have? Because if we don't, then the unemployment will lead to soft consumer spending, which in turn will lead to a weak economy, and we'll be stuck in a very stagnant but positive growth mode. So the government's going to have to do more. It's one of the big question marks is what they're going to do and how they're going to do it. I think there's going to be a lot of disagreement on that. Right now, they're doing it through spending, through government outlays, on infrastructure, on projects, through transfers to states and localities in the private sector. There's a minority of economists that would argue they ought to do it more through tax cuts. That's a problem because we have big deficits. You put your finger on the big problem for sustaining recovery at a reasonably high rate, and that is what's Washington going to do? I can't tell you right now what Washington's going to do. We're not sure which way they're going to go.
Dr. Sinai, we've had a wonderful year in the equity markets because of the economy doing better than expected. The world didn't end like some people were thinking last year. Moving forward, you said we are going to muddle through. So first and second quarter are going to be good. We've got stimulus. We might get more stimulus. We might get a jobs program. But what about the second half of 2010 and 2011? If we do slow down, like most economists expect, what does that do to the equity markets? Do you think we are fully priced, fully valued here, or we are after the second half headed lower?
Well, right now we're in good shape on the equity markets. I would encourage everybody to look at earnings and not GDP. It's earnings and interest rates that drive equity prices. And in the case of the aggregate earnings, say for the S&P 500 in the United States, they're going to be very good, very strong. We're expecting 20 to 25% gains next year, which is going to be 5 to 7 times the rate of growth of GDP. So investors need to keep their eye on earnings. Companies are doing a great job on earnings. The economy will grow over next year. It might slow down in the second half, but it will grow over next year, and that means there'll be some revenue growth, along with the cost reductions that companies are using to keep those earnings going. Plus, so many companies now orient their businesses outside the U.S. where there is quite strong growth in Asia, outside of Japan, for example, in parts of the Eurozone and Europe. Canada will probably have a very good year. Australia and New Zealand going to be strong. Parts of Latin America. So those companies that are less focused on end markets in the U.S. are going to do better because much of the non-U.S. world is going to grow in a V-like way as they come out of their recessions. And frankly, we'll probably be able to sustain a recovery and expansion longer than the U.S. can. So with earnings up that much and interest rates likely to stay low, particularly those controlled by the Federal Reserve, unfortunately, still low returns in cash. For the stock market, low returns in cash mean a lot of monies will go to stocks. The really strong earnings will help stock prices, and we should be good for well into 2010 for continuation of this equity bull market. We are thinking that we'll see 1,250, 1,300 on the S&P 500, which would be 11,000 to 11,500 on the Dow Jones by mid-year or shortly thereafter. Should be a good year for the stock market.
So it should be a continuation, not as robust as we saw from the lows of March to where we are now, but you think we are going to continue to, but that has been historically the pattern. When we go into a trough, we get a snapback, but the year after is what we have to look at, and you're expecting that to continue. Dr. Sinai, let's quickly touch on banks. The president invited the fat cat bankers, as he called them, to the White House. Some of them couldn't make it because of weather considerations or maybe something else. What is the situation with the banks right now? They've been allowed to they don't have to mark to market. They're holding on to a lot of assets. They're giving TARP money back. Are they going to lend to the small businesses and the average person out there, which is having a very difficult time right now?
Yeah, it's tough to get a loan, and if you're refinancing mortgages, it's tough to do. The reason banks are tough is the credit environment's tough. The American consumers and businesses have been in a very tough situation. Bankers are not taught to lend into a tough credit environment. On the other hand, the government, we did shore them up. We did provide taxpayer money. Most Americans, I think, believe a lot of the fault for what happened lies with the banks. And so we have this tension of having given the banks money, maybe kept some of them in business when they wouldn't have been in business, and looking for some returns in terms of lending. So I think we're going to get some give by the financial institutions. They're going to lend some more on the margin, look for creative ways to do it, and try not to compromise what they are basically shareholder bound to do, which is not to take chances on the loans and get into trouble again.
Dr. Sinai, I want to thank you for taking the time out today of your busy schedule and being with us today. Everyone, that's all.
Thank you.
You're very welcome. That's all the time that we have today. We will be back tomorrow. Until then, good trading.